Welcome, everyone, to the Adjusted for Risk podcast here from the shores of Lake Tahoe. So January was a strong month for equities. The S&P 500 returned a positive 6.28% during the month, which is the best start of the year since 2019, when the S&P 500 posted a 8% return. The January 2019 rally was similar in that it was driven by a hawkish-to-dovish pivot from the Fed. Not surprising, the expectations of a dovish pivot this go around towards December and then into January benefited growth stocks in January as well, as growth stocks outperformed value stocks. So it sounds like a broken record, but the Fed continues to drive markets in its actions, words, and forecasts. While January was a very strong month for equities on the assumption that the Fed was turning dovish, February, on the other hand, has been flat for equities. And following the Fed's February meeting, equities gave back all their gains from the first few days of the month, as hopes for a dovish pivot might have been a little premature. So going back to that meeting, the Fed meeting, I'm recapping the Fed because it is driving markets right now, and it's going to continue to be the primary catalyst for markets moving forward. So as expected, the Federal Reserve increased its key short-term interest rates by 25 basis points to a range of 4.5% to 4.75%. The 25 basis point increase was a pullback after the central bank increased rates by 50 basis points during its previous FOMC meeting and 75 basis points during the 4 meetings previous to that. So while a year-over-year inflation has slowed to 6.5%, the economy remains modest, as the Fed says, and the labor market remains tight. The 25 basis point hike was largely priced into the S&P 500, or priced in the markets, as S&P 500 rose just over 1%, while the tech-heavy NASDAQ 100 rose over 2%, and the Russell 2000 index rose just over 1.5% on the day. So despite that slower pace of softening inflation, the Fed still stated that ongoing increases are needed, and a couple more are likely this year. While investors are looking for signs that the Fed is ready to put an end to this rate hiking cycle, the statement did them no favors. Statements like ongoing increases disappointed some, as the Fed remains committed to bringing inflation down to its 2% target. And it's not ready to signal an end is near in this cycle. As for inflation, the Fed statement read, inflation has eased somewhat, but remains elevated. However, that statement did not mention supply and demand imbalances. Fed Chairman Powell also said, while recent developments are encouraging, we will need substantially more evidence to be confident that inflation is on a sustained downward path during its post-meeting press conference. During its December meeting, if you recall, Fed officials forecasted the terminal rate to reach 5.1%. However, prior to the Fed announcement at the beginning of February, traders forecasted a terminal rate of 4.88%. That forecast jumped to the current level of 5.16% following the Fed's announcement in February, first couple days of February. Why is that noteworthy? Well, that forecast of a peak interest rate or terminal rate, like what we like to call, of 5.1% is the highest this cycle. And in response to a question about the terminal rate, Powell stated it's possible that the Fed funds rate could stay below 5%, but also said it's unlikely the Fed will cut rates this year unless inflation declines rapidly. The impact of the Fed announcement in climbing forecasts for the terminal rate has had a big impact on the yield curve. The highest yield on the Treasury yield curve is the 6-month T-bill, which sits near 4.9%, followed by 4.88% for the 12-month T-bill and 4.77% for the 3-month T-bill. That Treasury yield curve inversion has deepened as well, as the 2-year yields continue to climb on expectations that rates will stay higher for longer, while 10-year yields are being pushed downward on concerns about slowing economic growth. It's no secret the Fed is slowing its interest rates hikes. The question now becomes, will the central bank conduct one more 25 basis point hike or 2 more, one in March and one in May? Also impacting the Fed decision has been the strong labor market. Despite the alarming headlines that we keep reading of large tech companies and other large companies announcing large layoffs, the labor market remains strong and shows no signs of a recession. We received a strong January jobs report as non-farm payrolls blew past forecasts and increased by 500,000 in January. The unemployment rate is at its lowest level since 1969. While the Fed wants the labor market to become more balanced, the Fed is clearly focused more on taming inflation. And because of that, we are nearing the end of the rising interest rate cycle with 2 more 25 basis point hikes during the next 2 FOMC meetings before the Fed pauses its interest rate hikes, as I do believe they're going to become more sensitive to other economic data, the economic slowdown, and inflation continues its slow but gradual decline. This upcoming week, talking about inflation, is another big one for economic data with the release of the January CPI report. With uncertainty around Fed actions, it remains prudent to not take big bets in your clients' asset allocations. You may want to consider, again, barbelling growth and value due to the uncertainty about when the Fed will stop its rate hikes. And that barbell approach is a sound strategy with so much uncertainty. Value stocks have outperformed in 2022, in large part because of higher interest rates, climbing interest rates. Meanwhile, as I talked about at the top of the podcast, growth has outperformed in January as hopes that the Fed was going to turn dovish. Okay, so with that uncertainty, it's important to barbell growth and value and not take a big wager one way or another. Fixed income provides some solid income and total return opportunities as yields remain relatively attractive, while a potential for economic slowdown or possibly a recession provides some total return opportunities for fixed income. So let's move along to something maybe a little bit more exciting. And unless you've been living under a rock, it's Super Bowl weekend. As you know, I record these episodes on Fridays. So by the time you actually watch this episode, you're going to know the outcome of the game. I am thinking the Eagles may pull this off. They have a lot of momentum. They seem to be a little bit healthier, even though Patrick Mahomes has had a couple weeks off to heal his ankle. It just seems like the Eagles have a lot of momentum right now. At the end, I'm just hoping for a good game, as I don't really have a dog in the fight this game. As for watching commercials, I'm usually heading to the kitchen to get another beer, some more wings and nachos. So I typically miss most of the commercials. So next week, feel free to update me on some of the best commercials. Maybe I need to YouTube them. Otherwise, I hope at the end that it's just a very good game and one that we can remember, that maybe it went down to the last few seconds. So with that, thank you all very much for listening and watching this edition of the Adjusted for Risk podcast. A reminder, you can watch past episodes on the Adjusted for Risk YouTube channel, or listen to the podcast on Spotify or iHeartRadio. You can also get more of our insights on our A Wealth of Insights from 6,237 Feet blog. So with that, thank you again very much, and we hope you have a great rest of your week. Thank you.